Hey there. Today we're going to talk about credit and risk analysis as it relates to credit. Normally, when we're talking about investments, we're talking about stock. And I think this will give you a slightly different insight into how companies work and how investments work because investors, just like they can invest in stock, also have the option to invest in debt. And so we're going to talk today a little bit about what debt is all about and how you do financial analysis for purposes of lending money instead of purposes of purchasing a company's stock. So companies need debt in order to fund operations, investing, and financing activities. And what debt allows them to do, as opposed to equity, is debt provides a source of funding that's not going to impinge upon their ownership rights. So, for example, if you were to issue stock, then your percentage ownership of the company would be reduced, and your ownership in the company would be a lower percentage. If you issue debt, on the other hand, then you maintain your percentage of the company's ownership, but you take on the obligation of paying back the debt. So companies, of course, need money to fund their various activities, especially to fund investments. And lots of people are in the business of lending money. Various different creditors, banks, many investors choose to invest in debt rather than investing in stocks, and private lenders. And there's a market for interest rates, and so this market oftentimes determines the cost of capital, i.e. the cost of borrowing money. So this is set depending on the supply and demand situation at any given time and who's borrowing money, especially by the federal government. So companies need to borrow money, oftentimes for their operations. And this is a little dangerous because you don't want to borrow money to fund losses. Obviously that's a pretty dangerous thing to do. So usually what companies borrow money for in a more healthy situation would be situations where they have cyclical needs. In other words, you take a company, say, that sells ski equipment. And most people buy ski equipment, and companies sell ski equipment in the fall and towards the beginning of the winter. They don't sell it in the summer. So for a company that makes ski equipment, or let's say sells ski equipment, then they would have great cash flow coming in October, November, December, January, February, March. And then they would have cash flow going out in the winter. So let's say they need to stock up for the coming season, and they would do that over the summer. They have very little money coming in. So that would be a time when it would make sense for them to borrow money. What they would need to do is they would need to be pretty sure that they're going to be able to pay that money quickly. And that's often done through a line of credit or what's called a short-term note payable. There's companies that borrow money routinely just to keep their operations going. But history has shown that they can do this fairly easily. One example of that is factoring accounts receivable. What companies will do is they'll use their accounts receivable as collateral. Factoring is slightly different. But they'll use their accounts receivable as collateral in order to borrow money. So the minute they sell something, they got an accounts receivable. They bring the accounts receivable to the bank, and the bank loans them some money against that accounts receivable. And again, that would be a situation where they were sure they're getting the money because they have an accounts receivable, but they need it sooner, and so they borrow the money in order to cover themselves. Other times you may have companies that are doing very poorly, and for one reason or another, they don't want to issue stock. Maybe no one wants to buy their stock, and so they wind up borrowing the money instead. And that's obviously a riskier thing. What's more common, and I think a little healthier, is when companies borrow money for investments. And the best kind of investment you could do would be new equipment, new PP&E, because this is going to generate new profits. It could also be for mergers and acquisitions. If the company is buying another company, it could issue stock to fund that purchase, and it could also issue some debt. And so then it would also make sense for them to borrow money. And companies could borrow money for their financing activities. And usually what they're doing here is they're borrowing money to pay other debts. And this may be the company carries a certain amount of debt on its balance sheet all of the time. Let's say that approximately 30% of the company's assets are debt. And debt, because it is debt, comes due every once in a while. And therefore, the company needs to refinance it. And so it'll find another bank, or maybe work with the same bank, in order to borrow money in order to pay off other debtors. So this kind of becomes a never-ending cycle. So they're actually borrowing money, but the only time they pay it back is when they borrow more money to cover the old debt. And this is very common. There's nothing wrong with this. The book here, they call it Evergreen Debt. They consistently pay off the debt by taking on more debt. And this is not to say that this is not a healthy thing. Many companies do it, and as long as the percentage of debt on their balance sheet is a healthy percentage for that company, then it should be a good thing. And it should not be an undue risk for the creditors, and it should be not be an undue risk for the debtor either. So where does debt come from? We have what we call non-bank financing. There are many businesses that are in the business of loaning companies money. And so one common source, in fact, is trade credit here you see in the middle. That would be accounts payable, bank loans, publicly traded debt like bonds payable, and also lease financing. Many leases are legally they're leases, but financially they're really debt. And so these are sources of funds to help a company with their operating, investing, and financing activities. Trade credit would be a situation where a company, when they purchase goods from their suppliers, they have the ability to pay them within 30 days, 60 days, maybe even 90 days. This usually has no interest, and suppliers are expected to do this as a courtesy to their customers. It's a really great source of funding for companies, not for suppliers, obviously. If you look at Walmart's balance sheet, for example, Walmart has a huge amount of accounts payable because it has a lot of power with its suppliers. So it can pretty much dictate the terms of its purchases, and those terms inevitably include a lot of accounts payable. Accounts payable is interest-free. If Walmart had to borrow the money formally with a bond, then it would have to pay interest. So accounts payable as trade credit is a really great source of funding for a company like Walmart. Bank loans are structured between the company and between the creditor and the debtor, and it reflects the priorities of both. One very common form of a bank loan is what's called a revolving credit line, and this would be where the bank makes a certain amount of money available to the debtor, and the debtor can borrow it when they need it, and they'll just pay interest on whatever amount of money they actually owe. So for example, you might have a $10 million revolver. That's what they call it, a revolver. And when you need the money, you take it. And when you have extra money, you pay it back. And it all needs to be paid back by a certain date. And the nice thing about this is that the company can take the money, or I should say borrow the money, only when it needs it. So if it needs the money, for example, for its operations, then it borrows the money, and then as more money comes in, they sell all the skis, let's say, then they can pay it back. Line of credit would be similar to a revolving line of credit. Usually it's more like a note, or a letter of credit is similar to a line of credit. A letter of credit is almost like a check. And they were very common in doing business in the 1800s, early 1900s. What you would do is when you were going to buy something, you would give your seller a letter of credit as payment. And then the seller could go to the bank and collect that letter of credit. And then you would have to pay back the bank. One common thing is what's called a term loan. And that would just be an interest note, a certain note with interest rates and specific payments to be made. And a mortgage, the difference between a term loan and a mortgage is really just that a mortgage has collateral, and the collateral is going to be real estate. Non-bank private financing would be private lenders that just loan money in one particular area. They have expertise in this area, in your industry, let's say, or they just work with your company, and they loan you money as you need it. They're in the business of doing this because oftentimes they can earn more in interest rates, and the interest rates are more secure than equity financing. And oftentimes they'll have investors on the other end who give them the funding in order to make these loans. Lease financing, if you took intermediate accounting or financial reporting, you've seen lease financing before. And this would be, it sounds like a lease where you rent things, and legally it's structured as a lease, as a rental. But the reality is that you're really borrowing the money. And why? Because let's say you need a vehicle or a piece of equipment and you choose to lease it. Well, you enter into a lease, let's say a 10-year lease, and you make monthly payments. And at the end of the lease, you might buy the piece of equipment back for $1, or you may be required to give it back to the bank. But it only has a 10-year life, so after 10 years, you might as well just throw it away. But that's not very different from buying it and taking out a loan to pay for it. Because when you think about it, you're getting used to the equipment and you have to make monthly payments. One way or the other, you're getting used to the equipment and you have to make monthly payments. This is a way of paying for the equipment. You don't have to pay for it with cash. So that's why lease financing is also considered to be a form of borrowing. Not all leases are, by the way. And then there's publicly traded debt. And this is maybe what you're most familiar with from your finance class. And these would be bonds payable or other forms of commercial paper. And they're publicly traded, so investors can buy and sell them. This may give you a lot of flexibility in setting up the bonds the way you want them to be and getting the most competitive interest rate. If you're borrowing from a bank, the bank's really kind of a go-between you and the investor. And so the bank is going to take fees or take a share of the interest. Whereas with bonds payable, what you're paying is going to be pretty much what the investors are receiving. The bank is still, of course, going to charge you a fee. But this is a way to get something that's probably closest to the market rate. But usually you're not going to issue bonds unless you're borrowing very large amounts of money. And they don't necessarily give you the flexibility of a revolving line of credit where you could just take the money as you want. With bonds, you issue the bonds and you get the money, and that's it.